Hello and welcome to this latest video update for the Henderson International Income Trust. Today I'm joined by the portfolio manager, Ben Lofthouse. Ben, thank you very much for joining me today. Now first off, it looks like you've been trimming down the portfolio since we last spoke at the turn of the year. So what's the story there? Why have you brought the number of holdings down?
Yeah, I wouldn't say the number of holdings falling is anything structural. I think we've just seen the opportunity in quite strong equity markets this year to finish taking some profits in some areas of the portfolio where we've held companies for long periods. And I think also just to reflect the fact that there is a bit slower economic growth. So again, some of the areas that have rebounded are more cyclical, and we've taken a few stocks out from some of those areas.
Okay, now looking at the portfolio, which stocks have been performing well in the year to date?
Yeah, it's been a really interesting couple of months this year, very interesting 6 months. Things that are performing well in the portfolio are a real mixture. So we've got some cyclical kind of areas that sold off quite aggressively last year in areas like technology, semiconductors. And we actually took opportunity of some of the dislocation in those areas last year to add to those stocks, and in some cases initiate new positions. So, it's been really good to see them rallying this year. But also there's been a kind of a big move in the bond markets around the world. So you've actually seen yields falling, so bond prices going up. And as a result of that, you've also seen some of the defensive stocks performing well this year. So some of the areas where we have some companies like that do towers for telecommunications, some areas like telecommunications themselves, food and beverage, these types of areas are also performing well. So it's quite an interesting area where we've got both some cyclicals and some defensive areas going well. I'd say that the toughest area in this environment with the bond yields falling and yields performing well and interest rate expectations falling has been the financial area. I think over the last year we have taken out some of the financial exposure in the fund on the view in some cases that we'd made good money, and in other cases perhaps that the interest rate environment wouldn't be as supportive as we might have hoped.
And now turning to the macro view, there's a lot of nerviness in markets around the world with global growth slowing and headwinds facing investors geopolitically and economically. So how has your outlook been affected by the first 3 months of this year?
Yeah, at the start of the year, I think I would have said to people there are a number of uncertainties coming up over the next 6 months where we'll get some sort of resolution. We're getting there on some areas. So the Federal Reserve in the United States was quite aggressively tightening interest rates last year into the face of some slowdown in growth around the world, if not in the US at that point. We've had confirmation this year that certainly the central bank in the United States is slowing down on and potentially stopping tightening of interest rates, so increasing interest rates. So that's relatively positive for equity markets because it suggests the risk of a policy mistake, certainly in that area, are less. We don't really have much more clarity on the trade talks yet, so that would be the other area where we're looking for clarification. Those talks have been delayed. They definitely don't affect all equities. They affect sentiment around equity markets. But in a portfolio like ours, it's quite a minority of stocks that get impacted, but it's definitely weighing on sentiment. And I think it's affecting businesses' decision-making capabilities. So those would be probably the two areas for me this year that are relevant. The third area, which I think is going to become very interesting, is the rate of growth in China. So I think we've seen a period where Chinese growth has slowed. We've seen some policy measures to address that, but at the same time we have the overhang of the trade tariffs. So I think through the first 6 months of this year, we're going to see whether Chinese growth is stabilising. We've certainly seen some measures announced in China to try and stimulate growth. The market's currently quite sceptical about whether it's enough. So that would be probably that, and trade talks would be the two things that remain as the big uncertainties.
Okay, and now how does that affect the global dividends picture?
Yeah, so what's quite interesting is that we've seen a number of companies announcing their dividends based on last year's figures. And although we've had some volatility in markets towards the second half of last year, we've actually seen some quite positive dividend announcements. So, the majority of the European companies that we own have announced their dividends, and that they are similar or slightly increased on last year. Similar in the US, we're seeing dividend trends continue to be quite strong. With areas that have been stronger in recent years, such as financials and energy, have seen kind of more confidence than they had a few years ago. And other areas that have been stable for quite some time are still stable. So areas such as pharmaceuticals, food and beverage companies that we hold certainly have continued to increase or hold dividends. So the dividend picture from the portfolio has been far more stable than the kind of macroeconomic data would suggest.